Market corrections get people's attention, but it's what investors do during these moments that may impact long-term outcomes. Yes, corrections are normal. Yes, volatility is part of investing, but caution matters because history shows us that panic can be far more impactful than the market itself. Let's look at a powerful example. In 2008, the S&P 500 dropped approximately 37%. Market sentiment was at historic lows, and headlines were relentless. Historically, we saw many investors pull out near the bottom because it felt safer to stop the bleeding. Past performance is not indicative of future results, but here's what happened next. In 2009, the market began to recover. The S&P rebounded by 26%. That recovery didn't just help investors who stayed invested, it punished those who didn't. If someone sold near the bottom of 2008 and missed the rebound, that combined impact wasn't a 37% loss. The difference between the high and low was closer to 60% of the realized losses. Why? Because once you lock in losses, you may need significant returns just to get back to even. And those recoveries often happen quickly, when fear may still be high and confidence is low. This is where caution comes in. Caution does not mean reacting emotionally. Caution does not mean abandoning a plan during stress. True caution is intended to provide a framework for understanding your risk before a correction happens, having a portfolio designed to be aligned with your time horizon and income needs, avoiding decisions during periods of extreme volatility, and recognizing that the worst days in the market are often followed by some of the best. The danger isn't the drop. The danger is making permanent decisions during temporary events. This is especially critical for retirees and near retirees, where timing mistakes may impact income, lifestyle, and legacy. Market corrections test discipline. Market corrections are inevitable. Panic is optional. Rebounds can reward patience. And history consistently shows that investors who stay grounded, diversified, and strategic, not reactive, are the ones best positioned to recover and move forward. If volatility makes you uneasy, that's understandable, but that's not a signal to panic. It's a signal to review, rebalance, and refine your strategy with intention. If recent volatility has raised questions about your portfolio, your risk exposure, or your long-term plan, now is the time to pause, not react. Schedule a complimentary 15-minute strategy session to review whether your investments are aligned with your risk tolerance, your income needs, and your long-term goals. Make decisions from clarity, not fear.